Hi, I hope all of you are doing fine. So today I'll be discussing on what is goodwill and how to calculate goodwill following the super profit method. I've already discussed how to calculate goodwill by following average profit method in the previous video. So today I'll be focusing on super profit method. I hope you can remember this equation, this picture. Those who have gone through my video of on accounting series, accounting made easy series. So in that video I've discussed accounting is a process pertaining to transaction of a business. So where I have discussed about the business process with this equation, and you can watch that video, so that will be very helpful to you. I have used the same slide to explain goodwill today. So first we need to understand what is goodwill. I will again repeat it. Goodwill means the extra amount, extra value which the investor will pay for a business during the time of the acquisition of the business. Say for example, the total capital is 1000. By investing 1000 in this business, you can see the black arrow, the profit which this business is giving is 100 in the first year, 150 in the second year, 130 in the third year. So we can calculate average profit. I'm using simple average. 150 plus 100 plus 150 plus 130 divided by 3 is 126. So by investing 1000 in this business and remaining for 3 years, 126 is the average profit, is the return from this investment. So the investor, before calculating the goodwill or paying extra for this business, they'll try to see what if, how much return will be earned by investing in another business or other similar type of business or other investment avenues. Say for example, the rate of return in the market is 10% for 3 years. So the normal profit can be calculated on 1000. So 10% of 1000 is 100. By investing 1000 in another business, the investor would have earned 100. Now there are two options for the investor, either to purchase this business or either to invest this 1000 in another business. But looking into the picture, it is very clear. On the left hand side, green color, you can see normal profit is 100. So this is investment avenue 1. And on the right hand side, you can see by investing 1000, this is option number 2, the profit is 126. So this particular business is giving more return. Obviously 126 is more than 100 rupees. So that more, that extra which this business is giving is known as super profit. In order to calculate goodwill following the super profit method, investor, what they will do is they will try to analyze 2-3 investment avenues or investment options or businesses before calculating the goodwill. So in this case, the existing business is giving 126, whereas the other investment option is giving 100. And the extra profit which is being generated is 26. This is not normal profit, this is super profit. So obviously investors, they will know that this existing business is giving extra return, extra profit. Maybe that may be due to the USP, unique selling proposition, or any core competencies which this existing business has. So the investor will think, okay, the profit of 126, for how many years it is going to be continued? That is known as, I've already discussed, numbers of years of purchase. So say for example, the investors are assuming that this business is going to maintain the profit of 126 for 3 years, then the goodwill will be super profit into numbers of years of purchase. It will be 26 into 3, that will be the goodwill following the super profit method. 26 into 3 is equal to 78. So the calculation of goodwill following super profit method is very simple if we are able to understand the business process, if we can be able to imagine the business process, and if we can relate this process with the business. I'm again repeating it for you. Calculation of goodwill following super profit method. The investor will see other investment avenues also before they invest in any business. So if any business is giving extra profit, they will assume for how many years that extra profit is going to be continued. So when they multiply with that number, so in this case the number of years of purchase is 3, the goodwill is calculated. Even this concept can be used in investing also, making a portfolio also. Anybody who wants to invest in stock market, who want to invest in equity shares, can follow this concept. They can compare different investment avenues and they can do a comparative analysis. But since my objective in this video is not to focus onto that, I'll be creating one video on how to create a very good portfolio, or how investors can use this concept to earn profit in the stock market. But today's objective is to help student to understand the goodwill. Not only student, anybody who want to understand the goodwill following the super profit method. And in order to make it more easy to remember, I have written these steps. You can see point number 1, you need to see how much capital the business has, or how much capital the investor want to invest. And point number 2, normal rate of return. What is the normal market rate of return, that need to be calculated. And point number 3, average profit of the existing business which the investor is wanting to purchase the business, that need to be calculated. Super profit needs to be calculated by deducting normal profit from the average profit. And finally, super profit needs to be multiplied by numbers of years of purchase. I've already discussed what is number of years of purchase in the previous video of goodwill also. And if you want to understand this video properly, do not miss 2 previous videos on the accounting series, accounting made easy video series, and goodwill video series. I hope you are able to understand how to calculate goodwill following super profit method. And any doubts you have, you can write in the comment box so that I can explain it. So see you soon. Till the time, stay safe and take care of yourself.